Hello everyone and welcome back to the sessions on strategic financial management. Friends, in this class we are going to discuss a small, simple but a very important concept that is titled as EVA, Economic Value Added. In your syllabus, this is classified under the major heading titled as Corporate Valuation. Now, this concept of economic value added is so simple if you just try to conceptually understand it. The moment you try to look into the definition and calculations, you are definitely making a mess out of that. Try to understand the core concept that is most important. Now, whenever I talk about this concept of EVA, I remember an old incident. One day, I went to my hometown and I was observing one of my uncles. He was into his business. I just happened to discuss with him what business he is right now carrying out, how much money he has invested, what profit he is earning. And I was stunned by the fact that he has invested an amount of rupees 1 crore in that business. I asked him, Uncle, how much profit you are generating out of this business? He says, I am generating a profit of 50,000 every month, net of tax, everything. I said, 50,000 every month means just rupees 6 lakhs a year? He said, yes, just rupees 6 lakhs a year. I wondered if this money, rupees 1 crore, would have been made as investment in risk-free securities, around this much of profit after tax he would have anyway earned with all the taxation reliefs which Indian government would have provided, because my uncle is actually of little old age and I'm talking about the time when this incident happened. I explained him that if this much money you can earn without any hassle, why are you every day going to your office and why you are putting so much effort when simply your investment could have fetched you this much return? So what value addition you are doing, uncle? What value addition you are doing? He said, my son, you won't understand. I am just deriving pleasure out of this. Otherwise, what will I do sitting at home? Then I realized, okay, fine. There is no value for that pleasure. You cannot evaluate pleasure in finance. However, after our conversation was over, my uncle indeed accepted one thing, that yes, I am not generating any value economically. So there is no economic value added in that business. So what if this business would have generated more profits than what could be the usual amount of profit that is expected out of it? That surplus profit is basically defined as EVA, that is economic value added. So let me tell you one more story to make you understand this concept much clearly, and then we go into the technicalities of this concept. So the story begins this way. There is Mr. Jack who has recently started a business in the name of Jack and Company by investing an amount of $40,000. Now it is obvious that Mr. Jack would expect some returns on this investment. Mr. Jack expects 15% annual return on this investment of $40,000. So if you work out what would be the total expected profit by Mr. Jack, Mr. Jack would obviously expect 15% of $40,000, that would be $6,000 by end of the year. Now let us look into what is the actual profit generated by this Jack and Company. Jack and Company has generated actual profit of $10,000. Now can you notice one thing? The actual profit of $10,000 exceeds the expected profit of $6,000. So basically there is a surplus profit, there is surplus returns which is coming to Mr. Jack's pocket, and that surplus returns, if you can calculate, it is 10,000 minus 6,000, that is $4,000. This surplus return of $4,000 can simply be identified as EVA, that stands for economic value added. So after looking into this example, you might be wondering that this concept is actually so simple. Indeed, it is very simple concept, and the point is we have not introduced any technical terms over here, that's all, but the core concept has been conveyed through this small example. Let us now enter into more technical details of this concept of economic value added. Let us first understand, when you start a business, the capital of that business is originating from which sources. So we always talk about capital as a long-term supply of funds. So you know one simple thing, there are three different sources from which capital in a company could be arranged. That is equity capital, preference capital, and debt. When I say debt, it would include all types of long-term borrowings, secured or unsecured. It would include any kind of bonds or debentures issued by the entity. It could also mean that it has borrowed money from bank or other financial institutions, but the borrowing has to be long-term borrowings. So all long-term borrowings classified as debt is one source, and equity capital and preference capital are two other sources. Combined effect of these three components would be the total capital employed in the business. At later stage, when the company generates profit, those profit figures are accumulated in the reserve balances of the company and disclosed in the balance sheet. So you know one thing very well, all the reserve balances which indicate accumulated profit of the company are basically the retained earnings which typically belong to the equity shareholders. So when you consider reserves as yet another component of capital employed, you would count that also as a component of capital employed. But understand one thing very clearly, in such cases that reserve balance will be having the inclusion along with the equity capital. So you may identify these as four different components: equity share capital, reserves, preference share capital, and debentures, or you may simply call it as debt. Now these are the long-term sources of funds. Whatever amount of money that is arranged or generated through these sources is typically identified as capital employed in the business. So there is some capital employed in the business. Now capital will never come free of cost, right? There will be some cost towards this capital. What we have always been understanding this as concept of cost of capital. So this capital employed, which is obviously not freely available and the company will have to incur cost towards that, we can call this technically as capital charge. That is a charge for arranging the capital. So for this you have to go back to the concept of cost of capital. Now there are four sources. I told you debt. For debt you compute the cost of debt. For preference shares you compute the cost of preference shares. For equity shares you compute the cost of equity, and all the reserve balances which typically belong to equity shareholders, on these balances also you would apply the cost of equity. That means cost of equity, when you compute, that applies on equity share capital as well as reserves and surplus, and the debt and preference shares will also have their respective costs. These cost of capital for each component is generally presented in the form of percentage. These are individual cost of capital. We would want the overall cost of capital. The overall cost of capital is known as weighted average cost of capital. At intermediate level you have learned this concept already. I don't have to explain you that again, but just for your remembrance I would say weighted average cost of capital is basically the average of these individual components of cost of capital. So when you work out the total capital employed, on that total capital employed you simply apply the weighted average cost of capital and what you get is the overall capital charge. Once you obtain the capital charge, that is the kind of expected amount of profit to be given to these contributors. Now, how would you compute those surplus returns? To compute the surplus returns, you need to arrive at the net amount of profit. Now, over here, be little careful about one thing, because one component of capital charge is the interest that you would pay on your borrowed funds. That means the capital charge will include cost of debt. That is why the profit that is actually generated by the business is defined as net operating profit after tax. I repeat, it is net operating profit after tax. So let us try to understand what is the meaning of net operating profit after tax. Friends, you know one thing, what is the meaning of operating profit? Operating profit in any business is EBIT, that is earnings before interest and tax. So earnings before interest and tax is purely the operating profit of any business. To arrive at this profit, that is operating profit, what you do is, from sales you subtract cost of goods sold, arrive at gross profit, and from gross profit element you are supposed to now subtract only and only the operating costs, only the operating expenses. When you subtract all the operating costs or operating expenses, you arrive at EBIT, that is earnings before interest and tax. This EBIT is typically the operating profit. So we want the operating profit, but we want operating profit after tax, because whatever capital charge you have computed, each component of capital is computed as post-tax cost of capital. So the profit in your hand should also be post-tax, but because it has to be operating profit, it should include the interest component. That means from EBIT, you are supposed to subtract only the tax component, not the interest component. So from EBIT, when you remove the tax component, you would arrive at net operating profit after tax, NOPAT, net operating profit after tax. So it is not simply the net profit after tax, but net operating profit after tax, which indicates one thing very clearly, that the component of interest on borrowed funds is included therein. Now, the point is how to determine net operating profit after tax. We will definitely discuss by different approaches, by different ways, how to get that net operating profit after tax. Once you arrive at net operating profit after tax, from that you just have to subtract the capital charge, and capital charge can be determined by applying weighted average cost of capital to the total amount of capital employed. So if the total capital employed is rupees 10 lakhs and weighted average cost of capital comes to 18%, then 18% of 10 lakhs, that is rupees 1,80,000, would be considered as capital charge. And now what you have to do is, from the amount of net operating profit after tax, when you subtract the capital charge, you arrive at economic value added. So let us do one thing. Let us first write down some important notes, and once the notes writing is done, we will then proceed ahead with calculative examples. And few calculative examples, when you just cover with me, you will be very clear with the concept of EVA, that is economic value added, and then you can just practice some more examples for building up your understanding and confidence. Notes to be written down. EVA equals to NOPAT, that is net operating profit after tax. Now what is the meaning of net operating profit after tax? I will explain you. From that you have to subtract what we call as capital charge. Now what is the meaning of capital charge? That also I will explain you. So capital charge will involve two different steps. Step 1 will be determining the total capital employed. Total capital employed will be the aggregate of all those four components. And step 2 will be determining weighted average cost of capital. Now, the EVA equation, that is economic value added equation, will be net operating profit after tax minus weighted average cost of capital multiplied by capital employed, and the short forms have been mentioned over here with their full forms. Income statement for determining EBIT. You may start with sales less cost of goods sold and you arrive at gross profit. From gross profit you subtract only operating expenses and you arrive at net operating profit, that is EBIT, standing for earnings before interest and tax. The alternate way to do this, again depending completely on the information given in the question, it would be starting point as net profit before tax, and because it is a net profit before tax means all the non-operating items also has been adjusted. So we are going to apply a reversal effect on this, that is adding back non-operating expenses and subtracting non-operating incomes. And what we again get by this approach, I repeat, what we again get by this approach is nothing but net operating profit, that is EBIT, standing for earnings before interest and tax. So you may just note it down. I'm sure you would have finished writing this whole thing. So let us move ahead and write further. Determining net operating profit after tax. I told you this can be done by two different ways. One is you start from earnings before interest and tax, that is EBIT, that you have just determined through the previous working. From this you subtract the amount of interest, arrive at earnings before tax, then subtract the amount of tax and you arrive at the profit after tax. Why we are doing this? Because if you want to correctly compute the amount of tax, you should know the proper profit, and your proper profit which will be subject to tax is not EBIT, it is basically earnings before tax which is subject to taxation. Therefore, you compute tax on earnings before tax and you arrive at profit after tax when you subtract tax from EBT. And once you get profit after tax, add back post-tax interest, that is the amount of interest multiplied by 1 minus tax effect. So I explained you earlier, if you have paid interest of rupees 1 lakh and if tax rate is 30%, what you need to do is take 1 minus 30%, that would be 70%. 70% applied on the amount of interest of 1 lakh would give you rupees 70,000, which will be identified as post-tax interest, which should be added back to profit after tax to arrive at net operating profit after tax. Now please try to understand one simple thing. If at all you are following this approach of arriving at net operating profit after tax, you definitely can do this, but what you are doing, you should logically be clear with that. Because you want to arrive at the correct amount of tax, what is needed is you first arrive at the net profit before tax. For that purpose, you have to also subtract the interest element, because interest is a tax deductible expense. That means under income tax law, interest is a deductible expense. So to correctly arrive at the amount of profit that will be subject to tax, you have to first subtract the interest. Then when you get profit before tax, on that you compute the amount of tax, subtract the tax, you get net profit after tax. But we don't want net profit after tax, we want net operating profit after tax. For that purpose, the interest element that you have subtracted needs to be added back. But what you subtracted was a pre-tax effect. What you are adding back should be post-tax, because we want net operating profit after tax. Now, in most of the question solutions, you will be finding this approach. But I am suggesting you yet an alternative approach which could be much easier to understand and will give the same effect. Over there what you need to do is you take EBIT and simply subtract the tax on EBIT. For example, if EBIT is rupees 1000 and tax rate is 30%, simply subtract 30% of EBIT, and what you get, 1000 minus 30% as 700, that will be directly the net operating profit after tax. What you want, you can directly get. That means the shortest way to compute net operating profit after tax could be EBIT into 1 minus tax effect. For example, if tax rate is 30%, then you take 70% of EBIT and what you get is net operating profit after tax. I'll show you that alternate way of working also over here, and while we are dealing with calculative examples, you will understand why both of these would give you exactly the same figure. I would always prefer you to do the second alternative approach. I have shown this calculation because in most textbooks and in some of your suggested answers this approach has been given. You should not then worry that what is this, sir has not explained this point and why this has come up in the textbook or in this. So anyway, let us look at the alternative approach and let it down. Another alternate way of making this calculation, very simple and straight. You start earnings before interest, and from that you directly subtract tax, and what you get will be the same in the earlier table. It will be giving you result. So we are not subtracting interest and adding back post-tax interest. We are directly charging tax on EBIT. It will have effect. So the second alternative working we will while solving questions.